slide, and I'll take a little bit about Simon. You guys have already heard me talk about him a little bit. Today, Simon's going to be talking about trading success and what does it really take. So Simon Ree has amassed over 28 years of experience in the financial markets, starting as a futures broker all the way back in 1992 when he was like 7 years old. Which means he's super young. He has a deep passion for studying and trading the markets, and he genuinely enjoys working with fellow traders. Simon's notable career includes founding and leading the market desk at Goldman Sachs in Sydney and showcasing his experience in the financial industry. He's also held significant positions at Citibank in Singapore, where he further honed his experience, specializing in stocks and options. And if I didn't mention it already, and I think I did, he's also an incredible follow on both LinkedIn and Twitter. Simon is constantly sharing a lot of information. So for those of you that are on Twitter and you're Twitteraholics and stuff like that, please go find Simon. What is it? Just real quick, is it Tao Trading on Twitter? Or
no, it's just Simon _Ree.
Yeah, I thought it was Simon Ree. Okay,
yeah.
I was pretty sure. We do so much stuff together. I forgot. I do follow you on Twitter, though, I swear. Anyway, ladies and gentlemen, Mr. Simon Ree.
Thank you very much, John. Thanks for the introduction. Welcome, folks. Look, it's a real pleasure to be here. What I'll do now is just share my screen. Can you enable screen sharing, please, John?
Yes, I can. Apologies, your first speaker.
No worries.
Let's see. How about now?
Yeah.
There you go.
All righty.
Boom.
It's a real pleasure to be here. Jasmine is here as well. You can probably see her beautiful face just next to mine or below mine. Jasmine will help moderate any Q&A that we have at the end. She works with me in the Tower of Trading. Really excited about this class. My goal with a class like this is to show you at least a couple of things that will make you go, uh-huh. And really just share some useful information that you can walk away with today that will enable you to start improving your trading results and results in the market. So without further ado, let's dive right in and talk about the magic formula for rapid account growth. So this class is for you if you are a wage or salary earner without a strategy to grow your income more quickly than inflation. If you look at real wages over the last 40 years, they're basically flat. If you look at the stock market, it's up like 72 times. All right. So if you're a wage earner in this environment and not an asset owner, you need to have some other plans. Maybe you're just concerned about current market volatility, the potential for a recession, further declines in the stock market. If that's you, you'll get a lot out of this class. Maybe you're frustrated by market choppiness, the lack of trend and limited follow through on many moves that we're seeing will help you out there as well. Maybe you're stuck in a job, you're answerable to a boss that you don't like, and you're looking for ways to become your own boss. I believe trading is something everyone should consider if they want to become their own boss. Or maybe you just want to learn how to profit from trading so that you can retire sooner or richer or both. If you're any one of those things, or maybe all of them, we've got you covered. A little bit about me. I've got a Bachelor of Economics, graduate diploma in applied finance. And as John said, I've been working in the markets for over 30 years. I have experienced the highs of big wins as well as the worry, confusion of financial loss firsthand. So if you've been there, I've been there as well. And really my mission today is to try and help aspiring traders not make all of the mistakes I made early on. I left the banking industry in 2017 with a vision to help people live more creative, joyful, and inspired lives by alleviating the burden of financial stress that weighs so many of us down. And my mission is to revolutionize the way finance is taught by shattering long-held Wall Street myths. And since 2017, I've helped thousands of traders become more profitable in the markets. Spent 14 years at Goldman, where I did start up and hit the markets desk. Spent 6.5 years at Citibank in Singapore, working with some of the wealthiest billionaires throughout Southeast Asia. I'm also the author of The Tower of Trading, which is a #1 best-selling book in options trading on Amazon, one of the highest-rated options trading books on the platform. A little bit about what we'll cover in today's training. We'll talk about the quickest way to build wealth while managing your risk. We'll look at the major difference between trading a bull market versus trading a bear market. We'll look at how to make money in any market condition by exploiting both trend and counter-trend conditions. And we'll look at the keys to successful risk management. So let's start off by looking at the quickest way to build wealth while managing your risk. So I'm going to be I'm going to share the great stuff with you up front. The secret formula for rapid account growth is this: strong risk control plus intelligent use of leverage. Right now, leverage gets a bad rap because, yeah, your profits can be magnified, but so can your losses. But when you combine leverage with strong risk control, that becomes smart or intelligent use of leverage. And so everything that we'll talk about today is focused on bringing these two essential ingredients together. So how do we create consistent gains in a volatile stock market? With high valuations, tightening liquidity conditions, deteriorating economic conditions, this stock market environment makes it very much a trader's market. Buy and hold and hope, it just doesn't cut it in this type of environment. What you need to know is how to identify high probability moments in time to expose yourself to risk, rather than being exposed to risk all of the time, just hanging on, crossing your fingers, hoping that everything will just keep on going up. Now, being able to identify high probability moments in time while controlling our risk is what enables us to use leverage intelligently. But isn't it impossible to time the market, is something a lot of people have heard over and over again. This is just a myth that's been concocted and promoted by Wall Street. You see, Wall Street firms make their living charging a lot of fees for managing other people's investments. They've got no interest in you managing your own money and embarrassing the returns that they generate for you. And by the way, charge you a heap of fees for generating. So myths like this are continually recycled. Saying it's impossible to time the market is like saying it's impossible to fly a jumbo jet. It is impossible if you don't have the skill set, but once you've learned how, what once seemed impossible becomes almost second nature. A complete disregard for timing says that you've got no process, you lack the skill set, and you just parrot conventional dogma. So how do we create consistent gains in a volatile stock market? Well, we do it using options, because as an options trader, you can do all of this. You can make money from rising and falling markets. Yes, we made money. We made great money in 2022. You can control your risk. You can grow your account quickly, and you can generate a regular income stream from the market using options. So before we dive in any further, let's talk about what is an option. Well, look, good news is there are only two kinds of options: call options and put options. We buy call options when we think the underlying stock price is going to go up, and just think call up as in call up a friend. And we buy put options when we think the underlying stock price is going to go down, just think put down as in put down your phone. Now, the great thing about options is we can make outsized gains. Here's an unsolicited testimonial from one of our members, Dan Cosgrove. He made profit of 850%. This is one of his first trades. Beginner's luck rarely happens in options trading, but think about what it'd be worth to you in your account being able to make profits like this in your own trading. Here's another success story. Now, they're not all 850% returns, but even a 50% return in a matter of a few days, I'm sure you'll agree, is a useful return. Now, let's talk about why options are your best option. There are 5 reasons. Options are the best way for us to use leverage. All right, we can leverage a small amount of risk capital into potentially massive returns. There's that word leverage again. Options allow anyone to thrive in any kind of market condition. Options make it simplest for us to manage our risk. There's that risk management component coming in again. Options can provide consistent opportunities for high probability trading, and options are flexible and can be highly profitable in a crash situation when all the other investments are going down the drain. So let's dig into these 5 in a little bit more detail. So options are the best way for us to leverage a small amount of risk capital into potentially massive returns. Leverage, what does that word mean? Leverage just means large returns on a small capital outlay. Now, with an option contract, you get to control 100 shares of a stock, but you only have to pay a fraction of the cost. Let's have a look at this in action. So we'll look at an example in Microsoft. So when I wrote this up, Microsoft was trading at 241.73 a share. It's a bit higher than that now, but 100 shares in Microsoft would cost you $24,173. Or you could buy one at-the-money call option in Microsoft for about $1,000 that lets you control 100 Microsoft shares for 29 days. So it's like you're renting the stock for a month. Now, if Microsoft rises, the gain you make on the $1,010 outlay for the option could end up being similar to the gain you could make on the $24,173 stock purchase. Here's an example of leverage in action. This trade was from a little over a month ago. We bought a call spread in Decker's Outdoor at $4. 7 days later, we sold it for $9. Now, the stock had gone up 4.5% over that time. Yeah, that's not bad, right? 4% in 7 days is not a bad return. The options gained 125%, folks. So 125% gain in 7 days. What would it be worth to you having those sorts of returns in your portfolio? And of course, we can make money in a whole range of tickers. Here's another example in Match Group. Here we bought calls at $4.05. We sold them 4 days later at $12.05. The stock gained 7% in those 4 days, but the options gained 197.5%. All right, so this is leverage in action. Second reason options are your best option is that options allow anyone to thrive in any kind of market condition. When you own a buy and hold equity portfolio, you're basically crossing your fingers, hoping that the stock market goes up every day, because that's how you make money. Now, as an options trader, you'll relish all market conditions. As you heard earlier, we buy call options when we expect the underlying price to go up, and we buy put options when we expect the underlying stock price to go down. Here's an example of a bearish trade in Okta, where we made 142% gain in 2 days with put options, a put debit spread. Here's an example in Goldman Sachs. Again, this was about a month ago, where we made an 80.9% gain. Again, it was a fairly small decline in the stock. The stock only fell 4.5%. So here's leverage in action on the downside. 4.5% decline in the stock gives us almost an 81% gain in the put options. The third reason options are your best option is options make it simplest for us to manage our risk. Risk management is crucial to your success in trading. Now, options offer unlimited upside and limited downside. You might be thinking, wow, that sounds too good to be true. But this type of payoff even has a name. It's called an asymmetric payoff. Asymmetric just meaning not equal. Your maximum loss is limited to the initial premium that you pay for the option up front. And as we saw before, that is only a fraction of what the stock would cost you. So with options, we get leverage, which when combined with high probability moments in time equals smart leverage, plus we get risk control. So if you buy a stock, and this is your entry price right in the middle here, you've got unlimited upside if the stock goes up, but you've also got unlimited downside if the stock falls. And you got to worry about, oh, where do I place my stop loss? And, you know, if the stock gaps down or, you know, they have a bad announcement, any one of these unexpected events type events happen, the value of your stock can fall precipitously. With options, you've still got the uncapped upside here, but we've also got capped downside. All right. The most you can lose is the amount you pay for the option up front. So instead of this line continuing down to zero, as it does for a stock, it caps out at the amount you pay for the option premium. All right. So options are literally the finance industry's greatest risk management tool. The other great thing about options is that they can provide consistent opportunities for high probability trading. You don't need a heap of different setups. I use 4 setups in my trading. You don't need to load your charts full of fancy different indicators. Simpler is almost always better when it comes to trading. With options, you can trade stocks, bonds, gold, commodities, emerging markets, currencies with the advent of ETFs. Here's an example in the iShares Treasury Bond ETF TLT, where we made a pretty useful gain of 78%. Again, this was in 8 days on a declining price in TLT. You know, boring old bond ETF, we make a 78% return. Here's an example in gold where we made a 90% return. And again, that was in 15 days or 16 days. So the key takeaway is options offer you the ability to make significant gains on small moves in the underlying stock price, all while limiting your downside risk. The fifth, one of the more important reasons is that options are flexible and can be highly profitable in a crash situation when other investments are going down the drain. You see, we can buy put options to profit from falling stock prices. Even in a rising market, you can have 1 or 2 bearish trades on now and then just in case. And you can use options to hedge your portfolio. Here's an example back in February 2020. This is just before COVID hit the center stage of the world and the stock market had its swiftest decline on record. My hedging rules told me I should be buying some put options in the NASDAQ. So on the 20th of February, I bought some triple Q, that's the NASDAQ ETF, $230 puts at $4. Then COVID headlines started hitting the airwaves. 5 days later, I sold those puts out for $175 gain. Now, if I'd held on to them, would I have made more money? Yes, I would. But at this point, folks, my portfolio was up 24% for the month. All right. It was my biggest month ever up to that point. I just went to cash and thought, right, we've got this pandemic brewing. I'm just going to sit and watch the market for a few days and see what happens. I watched the market. It bounced back up into this area of resistance here. And using my trading rules, I bought a heap more puts on the triple Qs, rode them down. And in the month of February 2020, my portfolio was up 36%. It was my best month ever. And obviously, most people were having a pretty tough month back then. So that's the power of options and the power of hedging. Here's a more recent example in the NASDAQ where we made a quick 89.5% gain in 5 days trading, again, NASDAQ puts. So the key takeaway here is options are the finance industry's greatest risk management tool. So let's talk about the difference between trading a bull market and trading a bear market. Don't worry about official definitions, 20% this and that. Just focus on the prevailing dominant trend. And to do that, focus on the 200-day simple moving average. Quote from Paul Tudor Jones, he's a doyen of the hedge fund industry. He says, my metric for everything I look at is the 200-day moving average of closing prices. I've seen too many things go to zero, stocks and commodities. The whole trick investing is how do I keep from losing everything? If you use the 200-day moving average rule, then you get out, you play defense and you get out. Point being, if Paul Tudor Jones is looking at the 200-day moving average, you and I should as well. Now, I call this the Jekyll and Hyde switch. The 200-day moving average is widely viewed as the line in the sand between a bull market and a bear market. It's the dividing line between a long-term uptrend and a long-term downtrend. It gets a lot of attention, all right? Basically, everyone is looking at it or aware of it. Markets that are trading above their 200-day moving average tend to be slower, gentler, buy every dip kind of markets. But when a symbol crosses below the 200-day moving average, it's as if it undergoes a personality shift. Markets that are trading below their 200-day moving average have these characteristics. They're faster, they have a faster, scarier feel to them. The news headlines are generally negative, bad things seem to keep on happening. CNBC is running regular markets and turmoil segments. Bear market rallies can be ferocious though, and big enough to convince almost everyone that the bear market is over. Markets are easiest to trade when they're happy or bored, and a market that's below its 200-day moving average is neither of those things. So here's a chart on the NASDAQ, and you can see how as soon as it crosses under the 200-day moving average, the moves start becoming more wild, and the predominant trend becomes one of a downtrend. And also note how the 200-day moving average is regularly used as support and resistance, all right? So there are all sorts of clues you can glean just from watching this one very simple indicator. Here's the S&P 500 from 2005 to 2009. And you can see when price is above the 200-day moving average, it'll come back and check in with it every now and then. But the pullbacks are generally pretty small. The up moves are bigger than the down moves. It's a fairly well-behaved market. Then as soon as price breaks it, volatility picks up. All of a sudden, the 200-day moving average goes from being support to resistance. And then whoosh, we get a massive drawdown. All right. Massive personality shift once it crosses underneath. So the most obvious difference is that during a bull market, stock prices trend higher. During a bear, stock prices trend lower. So to thrive in a bear market, you need to learn how to profit from falling stock prices. This is a jarring reality for most who are conditioned to believe that stocks only go up. How do we know that? Well, Google searches for why did stocks drop outnumber searches for why did stocks rise by 4.5 times. Bear markets have a different personality. As you saw earlier, when stocks trade below their 200 moving average, they undergo a personality shift. They become more volatile, they change direction more quickly and more frequently, and counter trend moves can be dramatic in a bear market. This was the S&P 500 during 2021. The biggest pullback we had that year was minus 5.7%. You can pretty much ignore pullbacks or counter trend moves in a bull market. Now, this is the tech wreck from 2000 to 2002. The NASDAQ lost 83.5% during those 2 years. But but it had some insane rallies, up 41%, up 24%, up 53%, up 59% in this last rally. Most people would have been convinced that the low was in and the bear market was over, and yet it still went on to make lower lows. Now, 1969 and 1979 was another lost decade for the S&P 500. And I just ask you folks, have you got a strategy in place to thrive if we have another decade like that, which I think is quite a likely scenario at this point? So the key takeaway here is that moves against the trend in a bull market can most often be ignored. Moves against the trend in a bear market, i.e. bear market rallies, can be huge and cannot be ignored. So let's talk about how to make money in any market condition by exploiting both trend and counter trend conditions. So what we want to do is identify high probability moments in time to put our money at risk. I don't like being exposed to risk all of the time. To me, it doesn't make sense. I'd rather be in cash and only put my money at risk when there's a really good opportunity. And that's what these high probability moments in time are doing for us. That they're telling us when it's worthwhile exposing our hard-earned money to risk. Now, it's true that most of the time, stock prices are pretty random and pretty hard to predict, but there are moments in time when price becomes relatively more predictable, which is to say that the probability of outcome A happening becomes statistically more probable than other outcomes. Now, there are no guarantees in trading. That's why this job is called trading and not guaranteed profits. But what we're playing here is probabilities. So when we're doing this with options, we're looking for bullish and bearish opportunities, short-term opportunities. We can do this by either following the trend or by taking counter trend setups. Now, let's just define the meaning of the word trend for our purposes. Trend in our context refers to the direction of the price of a financial instrument. Now, trends can be up or down, bullish or bearish, strong or weak, long-term or short-term. They can be nascent or they can be well-established. Now, I've got to admit to you folks, I am a trend follower at heart. I love trend following because it is like sailing with the wind at your back. With trend following, you are always following the path of least resistance, and it feels easy. Now, my way of identifying a strong trend is I look for rainbow logic. Now, for an uptrend, what I'm looking for is for when the 8 exponential moving average, that's what EMA stands for, is above the 21 EMA, which is above the 34 EMA, which is above the 50 period simple moving average, above the 100 SMA, and there's our friend, the 200 simple moving average again. And you just reverse these signs for a downtrend. And I color code the moving average lines so they look like a rainbow on my charts when they're correctly aligned. My second oldest daughter, I'm blessed with 4 kids. Daughter number 2 was obsessed with rainbows as a little girl, and that's where I got the name from. But my charts are highly visual, intuitive, and colorful. You look at that chart, and in a split second, you know intuitively you want to buy the dip. This is an uptrend because you can see the rainbow. You just flip the script for a downtrend. All right. Again, my charts are highly visual, intuitive, and colorful. And again, when you see the rainbow inverted, you know you're in a downtrend. We're in a sell every rip kind of market here. So the important takeaway here is that rainbow logic reveals the path of least resistance to you and keeps you on the profitable side of a strong trend. Now, trend trades are relatively easy to find and manage in a market environment like this. All right. In this sort of environment where we're seeing a lot of rainbow logic, you buy the dip, buy the dip, buy the dip, buy the dip, buy the dip. You buy every single dip. Okay, every now and then you get a squirrely dip and you might lose some money. Like I said, there's no guarantees in trading. But by and large, you buy the dip and you make money. And you don't even worry about trying to trade these little pullbacks because they're just too small. You just buy the dip. Now, here are some examples of some trend trades. This was an earnings trade we took in Lockheed Martin where we made 216% in 4 days. This was a volatility expansion trade to the downside that we took in NEO. We made 100% in 4 days. Now, this is the S&P 500 in 2022. And in this sort of a market environment, counter trend setups are essential because we don't have one-sided market where you just buy the dip, or sell the rip. Here, we've got to be trading both sides of the market because there's a lot more two-way movement. The rallies are huge, so are the downdrafts. Remember these huge counter trend moves we saw in this NASDAQ chart? Yes, it fell 83% over the course of 2.5 years. But if you've just tried to hold puts or short through rallies of 41%, 53%, 59%, you're going to get your face ripped off in that sort of an environment. So with counter trend trading, we're looking to identify high probability market turning points. We're trading at short-term tops and bottoms. Now, we are betting against the medium-term trend, but these setups can be extremely valuable in volatile, choppy markets where trends have had limited follow-through. Here's an example of a bullish setup in SMH, the semiconductors ETF last year. You can see the predominant trend is down. We got lower highs and lower lows, but this was a counter trend bullish setup that we took. These are examples of bearish setups in SMH where we're buying puts here, selling them there, buying puts here, selling them there. So same chart, same indicators. We're just flipping the script depending on whether the setup is telling us to buy calls or buy puts, which is, do we think it's going up or do we think it's going down? A couple of recent examples of counter trend trades. Here you can see Johnson & Johnson was getting to the bottom of a nasty downtrend. 3rd of April, we bought some calls for $2.50. 5th of April, we sold them at $9.55. We booked a 282% gain in 2 days. So again, folks, what would it be worth having trades like this in your portfolio? Now, they're not all as dramatic as that. Here's a more modest one in Amgen, but again, we made 131.9% in 9 days. Still a very useful return, and this is where counter trend trades can really make you profitable in any market condition. Here's an example. One of our members wrote in and said, thanks for highlighting the PNC trade on this month's coaching call. Just sold and made a 65% gain. So he made a 65% gain in his options. That was in 8 days. And he was brand new to the program. This was his first counter trend trade. So well done on that trade, Nick. Important takeaway here is that by taking trades that are both with and against the prevailing trend, you can make money in any market condition. So let's get to the keys to successful risk management, because this is really what is going to keep you in the game for the long term. So why is risk management so crucial? It's because in trading, we're always dealing with probabilities, never certainties. So you need to adopt a deterministic mindset. You need to adopt a probabilistic mindset versus a deterministic mindset. A deterministic mindset is what we're taught in Newtonian physics. If A happens, B will happen. A probabilistic mindset says if A happens, B is more likely to happen, but anything is possible. Now, losing trades are part of the business. They are an operating expense. They're nothing to be afraid of with proper risk management. But like any good business, we want to manage and minimize our operating expenses. And that is where risk management comes in. Now, risk management is a nutshell. It's all about drawdown control. That's because a portfolio has a drawdown of 50%. If your portfolio value loses 50%, you've got to make 100% gain just to get back up to break even. You've got to double your portfolio value just to get it back up to break even. This is an enormous task that will break most traders psychologically. So you need to manage risk on your individual positions, but also on your portfolio as a whole. My tip is this. If I have a portfolio drawdown of 15%, I sell everything and go to cash for at least 24 hours. Because if this happens, it obviously means I'm out of sync with the market. Now, I'm happy to say this hasn't happened to me since October 2018. This is written in my trading plan. Now, why minus 15%? I know I can recover from that. If my portfolio drops 15%, I've only got to make 17.6% back to get back to break even. And I know I can do that. If I let it fall 50%, I've got to make 100%, and that is a tough ask. It's much easier to make 100% if your account's positive. It's really hard to do it if you're trading out of a hole. Now, look, not every trade works out. Here was a losing trade in Hershey. We lost 14%. Here was a losing trade in silver where we lost 31%. But crucially, the winning trades are much bigger than the losers. So yeah, we accept losers. We just cut them off at the knees. We prevent small losses from becoming big losses. So some important tips on risk management and trading psychology is keep your position size small, especially when starting out. If you ever feel like high-fiving yourself on how good of a trader you are, go flat. All right, this is my no high fives rule. If ever I feel like I'm God's gift to trading. I know the market is about to kick me in the butt. I'm about to get a real lesson. I go flat. All right. That's the no high fives rule. If ever you're having sleepless nights worrying about your portfolio, go flat and trade smaller when you get back to the market. All right. This trading is supposed to feel easy. It's not supposed to feel like something that stresses you out and gives you sleepless nights. If your emotions ever waver beyond mild contentment to mild disappointment, cut your position size. Like I said, you should never be feeling exuberant and you should never be feeling terrified. You can feel mildly pleased or mildly disappointed. That's normal human nature. But if your emotional swings are going beyond that, trade smaller. And this is key. Seek to book incremental gains rather than trying to hit home runs. Now, you've seen many examples of trades in today's class that I've taken where we've returned 50%, 100% or more in a matter of days. Now, what would it take to make just 5% per month? Well, if you can find 2 trades per month that make 50% while risking 5% of your net liquidating value, that's your portfolio value, you've done it. You've made 5% a month. You find just 1 trade a month that makes 100%, risking 5% of your NLV, you've made 5% for your portfolio. All right. It's not that hard. Azar from Canada writes in, he says his NLV is up 11% in 2 months. That was his first 2 months of the program. So that's 5.5% a month. It's totally doable. Vlad, he was just 1 month in and his NLV, net liquidating value, was up 9.5%. All right. So he's blitzing that 5% per month goal. Now, if, like I said, you find 2 trades that make you 50% while risking 5% of your portfolio in each trade, or just 1 trade that makes 100% gain while risking 5% of your NLV, you've made your 5% per month. All right. It is not that hard. The only reason it sounds hard is because Wall Street's been lying to you about what good returns are your whole life. Now, the maths is where it gets interesting. If you start with a balance of $10,000 and you make 10% per annum, which is approximately the long-term annual return of the S&P 500, at the end of 5 years, you'd have $16,000. It's not bad, is it? But it's not exactly life-changing. You start with 10,000 and you make 5% per month and compound it. At the end of 5 years, you got $335,000. All right. So we're starting to talk about life-changing returns, folks. So here's an update from another one of our members who's brand new to the system. Michael says he made 19 trades over 7 weeks, 57% win rate. His NLV, net liquidating value of his portfolio, increased by 20%. So he made 20% in 7 weeks, vastly exceeding 5% per month. So it's definitely doable, even for people new to the system. So to summarize, all successful traders have a system to help them identify high probability moments in time to gain exposure to risk, manage their risk, and override their gut impulses. Now, it's usually about this time people start asking me, well, how do I get access to such a system? All right, so let me introduce you to Options Academy Elevate. This is our flagship online trading academy. The core training is conducted over 60 video lessons. There's over 25 hours worth of content broken down into 7 easily digested core modules, plus some valuable bonus modules. You get 12 months worth of access. You can watch it as many times as you want during the year, anytime you want, and on any device. Now, before we go any further, let's just recap some of what we've learned today. Key takeaway number 1 I want to recap with you is lost decades are more common than you probably realize. And to thrive in this environment, you need to know how to make money in both rising and falling markets. And Options Academy teaches the very methods you need to be profitable in rising, falling, or crashing markets. Key takeaway number 2 is that options offer you the ability to make significant gains on small moves in the underlying stock price, all while limiting your downside risk. Options Academy offers the easiest, most engaging options trading education program on the market. Key takeaway number 3 today is options are the finance industry's greatest risk management tool. Professional risk management techniques are the foundation of the Options Academy methodology. Key takeaway number 4 is moves against the trend in a bull market can most often be ignored, but moves against the trend in a bear market, i.e. bear market rallies, can be huge and simply cannot be ignored. Now, Options Academy reveals high probability setups for both trend and counter trend trading. Key takeaway number 5, folks, is Rainbow Logic reveals to you the path of least resistance. Now, Rainbow Logic is an Options Academy trend identification technique that I developed that makes trend identification visual, intuitive, and fun, and keeps you on the right side of a strong trend. Key takeaway number 6, by taking trades both with and against the prevailing trend, you can make money in any market condition. Options Academy is the way to build abundant wealth in any market condition. Finally, key takeaway number 7, all successful traders have a system to help them identify high probability moments in time to gain exposure to risk, manage their risk, and override their gut impulses. Options Academy, folks, provides traders with exactly that system. So you get 7 modules. You get a module on technical analysis, the bounce setup, which is one of my go-to trend following setups, the volatility expansion setup, where we're looking for really big moves in a stock price, my explosive earnings setup. You saw some examples of those, like in Lockheed Martin, where we specifically trade earnings announcements. Module 5 is devoted to risk management. This is what will enable you to control your risk and keep you in the game for the long term and enable you the intelligent application of leverage. Module 6 is all on trading psychology, which is really the final frontier between a happy, confident trader and an aspiring wannabe. And then module 7 is where we go through counter trend setups. You'll also get access to my How to Hedge program, where you'll learn how to put hedges in place, like the example I showed you in February 2020. You get the ultimate guide to debit spreads. Debit spreads are a great way of managing your risk and reducing the cost of trading. And you'll also get a module on diagonal spreads. You'll also get these amazing bonuses, which have been specifically designed to fast track your success. You get access to my Options 101 online workshop. Even if you've never even heard of an option, this will bring you up to speed in an engaging manner with no complex math and no fluff. You'll get modules on how to set up your charts so that you're seeing the markets exactly the same way I'm seeing them, compatible with TC2000 and Thinkorswim. You'll get cheat sheets and blueprints so that you won't have to rummage through pages of notes. You can just download, print out a blueprint or a cheat sheet and have the essential ingredients at your fingertips. You get the scanning criteria that I use. These are a game changer because it's going to save you hundreds, if not thousands of hours of time over your career as a trader because you run these scans and in seconds, a list of high probability candidates will appear. Again, compatible with TC2000 and Thinkorswim. You also get an invitation to participate in our private LinkedIn group. We've got members from over 40 different countries around the world. And you get 12 months of unlimited help desk support. So when should you do this? Well, the opportunity cost of inaction is this. If you wait another 3 years to get around to this, in 5 years' time, instead of having potentially $335,000 in your account, you'd have just $32,000. So inaction is a choice that could potentially cost you a lot of money. So just to summarize what you're going to get, you'll get the 60 plus video lessons worth $1,997. You get access to my 101 Options 101 workshop worth $497. Setting up your charts modules worth $497. You get the ultimate guide to debit spreads, which sells online every day for $497. Same with How to Hedge, sells on our website every day at $497. You get that included. You get the field guide to diagonal spreads worth $197. The trade blueprints worth $497. Scanning criteria, probably worth multiples of that over your career of a trader, but we put the value at $497. Access to our LinkedIn private group worth $497. 12 months of help desk support, unlimited, worth $497. And you also get 1 free month of Options Academy Accelerate. Total value, $6,467, and it is a bargain at that price. But you're not going to pay that today. I want to acknowledge you for attending this workshop. You've watched through to the end, and this shows me that you're serious about improving your financial situation. I want to thank you for your time and your commitment by giving you a massive discount on this program. So on this workshop only, you can claim this entire package for just $997. John will provide you with the link. Just to give you a rerun of that super special bonus I'm offering, you're going to get 1 free month to try my flagship coaching program, Options Academy Accelerate. You'll receive a video from me each trading day discussing market trends, macro developments, and the trades I'm taking in my personal account. 100% transparency. I tell you the trades I took, how I manage them, the fills I get, the good fills I get, the crappy fills I get. It's all warts and all. You get invited to a bi-weekly webinar and you get a monthly market barometer. I'm going to give you 1 free month to try it out. It's worth $297. So on this workshop only, you can claim this entire package for $997, and all the risk is on us because you get a 14-day risk-free trial. And exclusively for the first 10 action takers today, you will also receive a 30-minute one-on-one Zoom call with me, valued at $300. So if you want to elevate your trading and become more consistent and more profitable, I really look forward to working with you. Grab this special offer. And I think we've got about 10 minutes, John, for some Q&A.
Yeah, and you have a lot of them here, and these are probably the most complex questions I've seen.
Oh, really?
Yeah,
Awesome.
they're diving in. So let's start with here. With a 15% drop, selling everything will have a possible tax and fee consequence. How do you factor that in to the total loss, or are you only talking about trading portfolio with a small percentage of total account?
No, well, I mean, I don't have a long-term buy and hold portfolio anymore. So all of my market risk money is my trading money. Look, I live in Singapore where there's no capital gains tax. So I'm not a licensed tax advisor. I can't advise you on that. What I can say though, that managing your market risk is far more important than ancillary tax considerations. If you've got that 15% drawdown, you just need to put the brakes on. It's not a case of pumping the brakes. It's a case of getting out of the car, all right, and just walking around the block for a couple of times till you cool off, let your emotions kind of ebb away, and then get back in sync with the market.
And that actually brings up a different topic that is not Simon related, but on Thursday, we're actually going to have a real tax accountant that'll be here who specializes in trading. So if you guys have questions like that, you can save it for him, and he's actually licensed to give you that kind of advice. One of the things that I found difficult is being able to find a trade at the right time. How do you set up a watch list and screen for your parameters? How much time do you have to enter your trades? Is it minutes, days? How does it work out?
So the scans are all based on the daily chart. All right. So 98% of the trades I take are based off the daily chart. I do all of my analysis when the market is closed because I live in Singapore. I trade really the first half hour, the first hour of the market. And I'm just, I know what price I want to get set at. And if the stock runs away from me, so be it. I never suffer from FOMO, fear of missing out. Very disciplined. If the price is where I want to trade at, I take the trade. Otherwise, I don't. And my typical holding period is anywhere from 2 to 3 days to 2 to 3 weeks. But once you've learnt the system and you've done your first 100 trades and you kind of groove the process, there's no reason you shouldn't be able to do this on average 20 to 30 minutes a day, running the scans, doing your analysis.
All right. It says from Steve, because you recommend buying at the most 1 lot per 30 contracts available, I would assume that most option trades would be small, except possibly for a large to mega cap stock. Can you have 100% plus years with a large account like you're probably trading? ?
Yeah, because if there are hundreds of stocks that meet my liquidity and open interest criteria. All right. Literally hundreds of them, pretty much every stock in the S&P 500 and quite a few outside of it. So my criteria are really not that onerous. Trading large liquid mega cap stocks and indices and ETFs are my preferred vehicles because getting in and out is never a question. There are situations where I will see a good setup in a stock that is less liquid. And in those cases, I just trade well below my means. I'll take a smaller position size.
So it's just ego. A lot of the questions really come down to this. It sounds like you're kind of answering the same thing. Like you're not letting your ego get involved in the trade. You're just following the rules that you put aside.
I'm just following the rules. Absolutely. Yeah.
Could you talk to larger trading accounts like 500,000 to $1 million at a 5% NLV? You are risking 25 to 50K per trade, where a trade has the potential for 100% loss if options expire. Taking smaller position size requires managing too many open positions. That wasn't a question. Sorry. I thought I think that's just more of somebody trying to make a statement here. And I'm not sure I get it either way. It says, how tight are your losses, Simon?
So I have what I call my OMG stop loss is if the option premium declines by 50% of what I paid for it, I will get out of position, no questions asked, gone. However, I have got very little appetite for letting all of my losing trades get to that level. And generally what we're doing is cutting losing trades off at the knees and exiting them well before they get to that level. So typically a losing trade might be minus 25, minus 30%.
Okay. It says, what is your average win per trade? Have you figured out an average for that?
Yeah, look, I mean, it depends on the year. If we're looking at this year, the average winner is around 70%. So the risk reward is about 2.1 to 1.
And then it says here, do you have a scanner? And then someone says, I prefer a scanner. Someone says, I wish you have a scanner. And then he says, I type in the question and you display a scanner. So I guess
they may have asked those questions before I got to the scanner, but
yeah, I think it was all happening as you were talking about the package.
Right.
Do me a favor one more time, Simon, because there's somebody's asking here. Can you just back up one more time, show everybody everything that they get? And we have dropped the link inside the chat for everybody out there. So there's a link inside the chat. It's dropped in there a few times. You just scroll up and down, you'll see it. And we're also going to send it out to you later. This is everything. Simon, just one more time, do me a favor, just run through it really quick. And then I promise we'll let you go.
Yeah, sure. So you get access to the core learning, which will teach you the 7 modules. That's worth $1,997. You get access to Options 101, which will get you up to speed on options, even if you don't know what an option is. That's worth $497. You get the modules setting up your charts, which will mean you're seeing exactly what I'm seeing on your charts in terms of how the indicators are set up and what setups I'm looking for, worth $497. You get the ultimate guide to debit spreads. I'm a big fan of trading debit spreads, worth $497. You get my How to Hedge program, which teaches advanced hedging strategies, how to build your own risk dashboard. That's worth $497. You get the field guide to diagonal spreads, worth $197. Trade blueprints, worth $497. The scans, which a lot of people have been asking about, I'll teach you how to program your own scans using my criteria in TC2000 and Thinkorswim, worth $497. Access to our private LinkedIn group, worth $497. 12 months of unlimited help desk support, worth $497 as well. Plus, you get 1 free month to our monthly coaching program, the Accelerate program. That's worth $297.
Awesome. And all of this is how much?
$997.
$997. Okay. So guys, this is over $5,000 off today. How long is, I guess the last question I have for you, Simon, it's a pretty easy one, is I know this is a special deal you put together for us here today for the event. How long is this deal going on for?
John, well, I guess we can run this until the end of the weekend.
Okay, perfect. So guys, you have a few days to react. The link is in the chat. You can follow Simon on Twitter. It's Simon_Re. Again, great follow, especially for those of you that are into the finances. Be careful. Simon's a little edgy out there. Gets on people every once in a while, but it's a fun follow. And you can go check him out. Simon, thank you so much for all of your time today. Jasmine, thank you for coming along and helping out. Ladies and gentlemen, taoofTrading.com, Mr. Simon Re. Thanks, Simon.
Thank you, John. Cheers, John. Bye-bye.
Bye-bye, John. Bye, Jasmine. Pleasure.
Am I leaving?
Cheers, Rod.
I'm staying.